I think that I think the mainstream media is running away with this hawkish narrative. Just your thoughts. I mean, do you think we're going to see rate hikes? And, how will that... First of all, do you think we're going to see rate hikes, Gareth?
So I would say I don't think so. I do think that we're already seeing a crack in the AI narrative where we're starting to see these other models out of China be much lower cost. And that is going to have a ripple effect through the CapEx spending that, in my humble opinion, has been the driver. It's the only reason we probably haven't been in a recession yet is because of the massive $1 trillion in CapEx from the AI infrastructure companies that's being spent. That and government spending, obviously, which probably will continue. But if that does slow down, I think, again, you look at total society, probably 75% of people already feel like they're in a recession. It's just a small percentage that are highly invested in the stock market that don't. And I think, again, the Fed is unlikely to hike rates as we will start to see a slowdown later this year. The other thing I would just say is that I don't buy this hawkish Kevin Warsh thing, right? So, we had Trump saying specifically he would never appoint anyone that was going to raise rates, and he wanted someone that was going to cut rates. And so while I think the first meeting from Kevin Warsh had to be a strong one, I'm going to get control of inflation, I'm going to do this, I'm going to do that, and the market obviously sold off on that, I don't buy that all of a sudden he fooled Trump and is going to be a hawk versus more of a dove.
I agree 100%, and that's why I call it this runaway narrative on the Fed being hawkish based on nothing we've seen yet that's concrete.
That's right. That's right. And also remember that Kevin Warsh has already floated the idea of excluding certain outliers from inflation to make inflation look lower, which gives you the green light to cut rates.
All right. Getting back to your gold chart, can you...
Before we go any further, if you enjoy fact-based market analysis instead of hype, make sure to subscribe and turn on notifications. Every week, we break down the biggest stories shaping gold, the economy, and global markets. Now, here's something most investors are missing. Gareth isn't saying gold's long-term bull market is over. He's saying corrections are a normal part of every major rally. The real question isn't whether gold is falling today, it's whether smart investors are using this correction to prepare for the next major move.
Okay, I guess my question is, your $3,500 call, I'm assuming you're sticking to it, or has it gone lower now, or what's a key level you're looking at right now, Gareth, on that chart?
Yeah, so like we talked about here is we do have a little support that I have to monitor because, again, if we look here, we had the big bounce right off of this level here. So here we had the big bounce. We hit it again. We had this big bounce. We hit it here. We had a smaller bounce, but we have to assume there's going to be some sort of bounce here as well. Now, on a technical basis, and remember, it's all about technicals. I have no control over this, and it's just the charts are the charts. If we were to break out above 4,300, that to me would say, okay, maybe the 3,900 area is the bottom here. So you're now getting to a point where you have these two trend lines converging, and that means that we're going to know probably within a couple months. It's one or the other. It's either a breakout or we're going to break down. If we break down, then the level becomes very crystal clear here. If we look at this, all of these high pivots along here, that was kind of like a ceiling that the market was hammering against on gold, and it finally broke out. There's always this tendency when you break out, and I'll just draw it in here, when you're hammering a lot and you break out, there's this tendency to want to go back, and then you go to the next leg up to the upside. And that's kind of my next all kind of the big level where I would honestly really be a buyer. Now, I will say this, now that we're below 4,000, we're now within $500 of my final target. To me, that's a rounding error in terms of, does it get down $500 more or does it go to $10,000 first, right? I mean, you have to start weighing this. And so for me, at least, I'm not opposed to starting to nibble here. I just wouldn't be going all in myself on a long-term holding in gold. At this level, I'd leave room to add as it comes down.
Awesome. Fantastic. Well said. Okay, let's pivot to silver now.
Yeah, this is a tougher chart. So listen, I've been saying 54 and then $50 is likely where it's headed. I still think 54 at minimum. I will start nibbling at 54, but I still think there's a highly likely chance that we're headed to that even number of 50 and even piercing 50. I think that's probably max pain for a lot of speculative investors. It's a break back below 50 where they would throw in the towel. Psychologically, that's what you want to see before a bottom can be put in. But I just want to show this to you because the charts were telling us that this was going to happen, right? When you look at this, this is called what I call a bouncy ball pattern. It's you have this huge move up and it's like dropping a ball from up here. What happens? Your first bounce off the floor is your biggest. Then your next one is your second biggest. Then you get this little one and eventually...
This is where experienced investors think differently from the crowd. Most people become emotional when prices fall, but professional investors often pay even closer attention during corrections. Gareth's main argument isn't that prices can't fall further. His point is that understanding market psychology is just as important as understanding the headlines. Fear creates volatility, but it can also create opportunity for patient investors.
It breaks to the downside. So envision just dropping that ball as how it bounces, the smaller and smaller bounces. But the more it hits this area, the more likely it breaks down. It weakens that support, and that's what's going on here. So we do have a breakdown on silver. The next key support level is $54. It's from these two pivots right over here in October and November of 2025. That's likely what we'll see in the next week or so. At that point, that will be a major support. But ultimately, I still go back to the fact that, you know, if you look at the bigger time frame, let's get rid of all of these lines and we're going to flip over to the monthly. Where is the most likely scene of the crime return?
Yeah.
I hate to say it, but
Oh, no.
your 1980 and
Oh.
your 2011 highs right there.
Ow.
And listen, that's about $50, right? It's not that far away at this point. But the one thing I will just say is that a lot of people rebut that and say, well, yeah, but inflation adjusted, silver shouldn't go back. But then remember, folks, is that in the short term, price is driven by emotion. So I'm a big buyer at $50 because I know emotionally it shouldn't be there, right? I mean, that's fear and panic driving it to 50 or 49 or wherever. And it eventually, you're right, inflation is the long-term fundamental aspect, and that's what will drive price back up. But again, short-term emotion rules the day, long-term fundamentals do.
Yeah, I just, I keep scratching my head over this, Gareth. I just have a gut feeling, specifically to gold, that there's a lot happening behind the curtain. I mean, we're seeing countries repatriating their gold. They want their gold back. We're seeing central banks, we don't trust the numbers. And the World Gold Council just came out saying the numbers they tabulated is 15x the amount that central banks said they're buying. So I just feel, I don't know. It just feels like there's a lot of non-transparent, nefarious activity happening right now, if I could.
And I agree with you. I think that in a fundamental, if you look at the breadcrumbs
Yes.
say silver and gold are going much, much higher. Unfortunately, we know, and you see this in the AI stocks with the ridiculous moves in some of these names up 300-400% on the year to $1 trillion market cap, is that momentum carries the day, right? And so even though, if you ask the average person walking by about, well, did you know that central banks are buying a massive amount of metal? They're like, what are you talking about, right?
The same pattern appears again and again across financial markets. Retail investors often rush in after prices have already surged, while institutions quietly take profits. Gareth uses AI stocks as an example, but the lesson applies to every asset class. Successful investing isn't about chasing excitement, it's about staying disciplined when everyone else is reacting emotionally.
But if they see that price falling, they're panicking and selling anyways, right? Because emotion is the biggest factor that we have in kind of determining what we do. And so I strongly encourage all the viewers, think logically, right? Yes, we may get down to $50. To me, that's a huge buying opportunity because fundamentally, central banks are buying, big money's accumulating. They're still going to depreciate fiat currencies with all, more printing of money. The debt's continuing to go up. All the major factors are there. We just have to look at this as a great buying opportunity, in my humble opinion.
For fun, I don't know if you have this chart handy, Gareth. Do you have SpaceX?
Yes, absolutely.
Speaking of momentum and how it can backfire.
Yep. Yeah, I mean, this is case in point. What we're talking about, right? Is that when this came public, it had 3 days of retail just FOMOing in. And then all of a sudden, and by the way, insiders like Goldman and the rest of them, they had shares. They're like, oh, thank you guys. Thank you. Sell, 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 sell.
Right.
And then price is now back down here. And now it's basically touched a point where yesterday it was at a level where everyone that bought after it became public was literally negative on their trade. I mean, it was at the lowest point. Now, if you got it at the IPO price of 135, you're still up, but that's not really a great gain. I mean, in all fairness. And Daniela, let me show you this one other chart, CBRS.
Yeah.
This is Cerebras. This was an IPO that it's a chip stock, so it's a semiconductor AI play.
Okay.
It was given to insiders before the IPO, $185. It opened at basically 310,
Okay.
goes to check that, it opened at 350, goes to 385. It's trading at $185. Like literally everyone that bought since this became public is down. That's exactly what we're talking about. This panic, and it works on the upside, but it also works on the downside. We just have to be smart enough and logical enough to take advantage when it comes down to these levels.
Right. So you're not touching that, obviously.
No, not now. Like if it gets back to, 185 is where the insiders, which is really interesting because the institutional money will defend that level because it looks really bad. If they're trying to land the next IPO deal and people are like, yeah, but you brought these guys public and it's below there, like, I don't really trust you. I'm not going to give you this business. And they make billions of dollars off bringing companies public. So at this point, I'm not touching it because also, we have Micron earnings after the bell today. I mean, all of these type of things, the chip stocks are just way, way bloated to me.